It's time now for Mortgage Matters with your host, Bill Sandvig. Bill Sandvig serves as market leader, running the South Carolina coast for Movement Mortgage. Movement finished 2014 ranked as the #1 mortgage company in purchase mortgages for the Charleston Tri-County area. And they're still growing. And now your host of Mortgage Matters, Bill Sandvig.
Good afternoon, Charleston. I'm Bill Sandvig. You're listening to Mortgage Matters. Got a great show today. We're going to talk about some common mortgage mistakes that other lenders are out there doing, mistakes that other lenders are coaching you to do. We're going to go over a bunch of different things that you can try to avoid, reasons why to avoid them. We're going to go into some big changes that are coming up on August 1st in the lending and real estate industry. If you're in the industry, you're going to know it as the TRID changes. But if you're going into a real estate transaction, everything is going to change as far as all the documentation that's coming out and all the way that this mortgage process takes place. And a lot of people are really worried about it. They're nervous about it. We're going to start seeing possibly real estate closings and loan transactions stretching out from what's already very slow for most companies to even slower. We're hearing rumors about 60 or 90-day closings. And think about that, trying to plan for moving your family and having to experience a 90-day loan process. It can be painful enough when it's done in 3 weeks. Now, and then we're going to go into why Dave Ramsey is wrong. I have a lot of conversations during the week with different customers that, bring up Dave Ramsey and Dave Ramsey approaches. And well, I got a little beef about some of the things that Dave has to say. A lot of the things, actually most of the things I agree with, but there's one thing in particular that I want to go into later in the show about why Dave Ramsey is wrong. And before we get into the show, I've got to share, we are here live in the studio. So if you have any questions, anything you want to talk about, whether it's mortgage related or finance related, please call into the studio, 843-556-1250. We're here on 1250 WTMA, the Big Talker. And I'm Bill Sandvig. If you want to reach me outside of the show, or you want to shoot me a text message during the show, ask me a question because you don't want to go live, just shoot me a text message at 843-300-7870. That's my cell phone. You can reach me anytime, day or night. My wife wouldn't be happy that I'm saying day or night, but go ahead. I'll respond if I can. You can also find me on my website at www.lowcountrylending.com. You can go there, get a free buying power evaluation. I'll let you know what your buying power looks like. It costs you nothing. The application costs nothing, and we can solve whatever questions you might have, find what opportunities might be there for your family, whether it's investing in a new home, buying a vacation home or a second home, or upgrading or downsizing. We can get you the answers. So please go to my website, www.lowcountrylending.com. Big news in my life this morning. My little sister, Krista Vota, and my brother, Phil Vota, just had their first child. I am now an uncle for the first time in my life. They gave birth to Piper Addison Vota, beautiful little girl, 8 pounds, 20 inches. And Phil and Krista, if you're out there listening, congratulations. I'm so excited for you guys. And you guys are going to be incredible parents. All right, so let's get into the first segment. The first thing I want to talk about is common mortgage mistakes. These are some things, just a couple of things that come up routinely when I'm talking to consumers, and they're talking about how they want to structure their loans, what they're thinking about doing as far as down payment or loan product or loan structure. And it's actually things that I hear from them that they've been advised from other companies. Other companies are making these recommendations, and I'm kind of surprised. Sometimes I'm surprised at the things that other lenders are advising people because I don't really necessarily think that it's always in their best interest. So here's the first one. The first one is putting more money down on your house to try and get a lower payment. In the mortgage industry, there is a point where when you're putting money down, it doesn't impact your interest rate anymore. If you're putting down 5% or 20%, there's a slight difference in the interest rate if you were to put down 5 or 20%. But there is almost no advantage from an interest rate and cost perspective if you go from putting down 20% to, say, putting down 50%. A lot of times when people are moving down from moving down to their retirement home and they sell their large family home that they've had for the last 20 years, they've got a whole bunch of equity. than that house, and they've got a bunch of money to bring down, and maybe they're buying their retirement home here in Charleston, and their thought is, well, I'm going to take this cash that I'm going to get from the sale of my house, and I'm going to put it into my retirement house and get that payment as low as possible. Here's why that isn't necessarily a good thing. When you put money down on a house with interest rates being so low, we're talking interest rates 4% still today, even sometimes lower than 4%, that you're not going to get a huge return when you put that additional money down. You're not going to save as much in your payment as you might be thinking. Here are the numbers. Try and stay with me. For every $5,000 that you put down more on your house, you're only going to save yourself $24 a month in payment. $5,000 equals $24 a month in payment. Now, we have to also remember that $24, if you were to not put more down and not avoid that interest, is also going to be tax deductible because mortgage interest is tax free. So the equivalent net cost after you factor in the tax savings is really only around, if we assume a 30 to 35% total tax bracket, it's really only about $18, $17 a month that you're saving by putting down $5,000. What's the break even on that? It would take 277 months of saving $17 a month before you made back that $5,000 you just laid out. 277 months, 23 years. Now, think about it this way. If a friend of yours, it's your very best friend, it's your brother, it's your child, they come in and they say, look, I need to borrow some money. I need to borrow $5,000. And you say, whoa, $5,000, is everything okay? What do you need to borrow the money for? And they say to you, well, I'm not going to really share with you what I need the money for. I don't really want to tell you. And so you say, well, okay, well, when can you pay me back? Well, I can pay you back $18 a month for the next 277 months, and that's going to be interest free. You'd probably look at your very good friend and say, I'm sorry, $18 a month for the next 23 years isn't going to be an okay terms for my loan. That would be the agreement that you're giving to the bank when you try to avoid that $24 a month in payment and that net $18 cost. So my advice is you put down the very minimum amount that you need to put down to get you the very best interest rate. And there is a point where putting more money down is not going to save you anything more in rate. And that can be very dependent on what your credit score is. If your credit score is marginal, then there can be an impact on how much you put down. But if you've got great credit, people don't know this. If you've got great credit above 740, there is no difference in interest rate if you put down 5% or if you put down 50%. No difference. Same interest rate. So that's the first one. Putting more money down in your house, I think that's a misconception. It's not necessarily a good thing. The second thing, and this one comes up all the time, lender-paid mortgage insurance. It's very common. People are going to buy a house. They know that they're not going to be putting down that 20% to avoid mortgage insurance. And so they ask me, I don't want to pay mortgage insurance. Do you have any mortgage-free products, mortgage interest-free products that I don't have to pay mortgage insurance while, in this loan, even though I don't have the 20% to put down? Yes, I have a product that will allow for what's called lender-paid mortgage insurance. There is a flat one-time fee that can be paid for by the bank, or it can be paid for by you upfront at the time of closing. And you don't have to pay mortgage insurance, and your mortgage payment will be lower going forward. The bank wins. When you take this product, the bank wins. And here's why. There's two ways that upfront mortgage insurance or that flat fee is going to be taken care of by you not paying mortgage insurance monthly. Either you're going to pay it in a huge cost at closing, and for a $200,000 loan, a $6,000 cost of mortgage insurance one time would not be out of the question. It depends on your credit, but $6,000 would not be out of the question. Or the bank is going to increase your interest rate. They're going to increase your interest rate from what the best rate you could qualify for is. So in effect, be collecting that mortgage insurance over the time that you're paying that loan. So you're not avoiding cost. The cost is not going away. It's just being placed in different places. It's getting distributed in a different manner. But here's why I don't think it's a good idea. especially if you're doing an FHA loan, you're going to have mortgage insurance. There's no way to get around it. You pay upfront mortgage insurance and monthly mortgage insurance. So this conversation only applies for conventional loans. When you're doing a conventional loan, the mortgage insurance on a conventional loan can go away in as little as 2 years. As soon as you have 80% equity in your house, you can call up your lender and request for an appraisal to determine if you have that 20% equity. And if you do, the mortgage insurance is going to drop off. So here's why I don't like lender-paid mortgage insurance. If you have mortgage insurance, yes, your payment will be a little bit higher, but when we're in an increasing housing market where property values are going up, it's very realistic that in 2 or 3 years, that mortgage insurance could be in a position to drop off. What happens if you trade not having mortgage insurance for having a higher interest rate? The interest rate is forever. It never goes away. The interest rate's forever. Mortgage insurance is temporary. So it's very, very likely that you trying to avoid a slightly higher payment now because of that mortgage insurance are going to have a higher payment over the entire life of your loan because of trying to avoid that mortgage insurance. The cost, I've done this math many times, the break-even point, assuming that your mortgage insurance would drop off inside of 3 years, which is very, very realistic, that in the 6th year, you will have given back all the money you were trying to save by avoiding mortgage insurance. And then if you have that mortgage from year 24 through 7 through 30, for the last 24 years of your mortgage, you're at a loss. You've lost. And with today's rates being so ridiculously low, it is much more likely than it ever has been in history that you're going to retain these mortgages and keep these mortgages for a longer period of time. So that's why lender-paid mortgage insurance, the bank wins. The bank gets their money right up front, or they're going to get it in a higher interest rate that you're going to pay them more over time. Lender-paid mortgage insurance, I don't advise it. It's not in the best interest of the customer. The only time that I do lender-paid mortgage insurance ever in my career is when someone can look me in the eye and say with 100% certainty that I'm going to be selling this house inside of 2 or 3 years. If they're going to be selling their house inside of 2 or 3 years, I say, okay, this makes sense. We just want to get your payment as low as possible for this couple of years you have this house because we know you're getting a new mortgage. We know you're moving on from this. So there's never going to be time to recoup that cost later. Or the other time is if the seller is willing to pay for the mortgage insurance. If you have such a huge credit from the seller for closing fees that we can tack that onto their cost, that would be a time to do lender-paid mortgage insurance. The third thing, common mortgage mistake, would be cashing out to avoid mortgage insurance. People get all caught up in trying to avoid mortgage insurance. I don't think that it's necessarily in their best interest. It doesn't make sense to me if you have 20% barely saved and to take everything out of the bank and put it on your house to avoid mortgage insurance. Mortgage insurance cost for someone with decent credit that's putting 10% down is very nominal. On, say, a $200,000 loan, your monthly mortgage insurance payment is only going to be around $70 or $80 a month. $70 or $80 a month isn't a huge deal, especially when you're putting down 10%. And you know that if your house appreciates just 3% each of the first 2 years you own it, and you put down 2% every year you're making your payments, that it should come to fruition that in about 2 years, that mortgage insurance is going to go away. So don't tap yourself out. Don't expose yourself to getting high interest credit cards or taking loans to get new furniture in your house or getting a high interest car loan just to avoid mortgage insurance, because it's not the end of the world. You don't need to cash out your savings. We are live here in the studio. If you have got questions about anything, about mortgages, about finance, please call into the show, 843-556-1250. You can call my cell phone anytime, 843-300-7870. Find me on my website at lowcountrylending.com. When we come back, we're going to continue with the last couple of points I have on common mortgage mistakes, and then we're going to get into some TRID changes, some big changes that are going on in the industry. This is Bill Sandvig, Mortgage Matters. We'll be right back.
There's more Mortgage Matters with Bill Sandvig coming up next on The Big Talker, 1250 WTMA. WTMA. You're listening to Mortgage Matters on 1250 WTMA. Once again, Here's Movement Mortgage's Bill Sandvig.
We are back live in WTMA 1250, the Big Talker. We are talking about mortgages, finance. This is Mortgage Matters. I'm Bill Sandvig. If you've got any questions, we're live in the studio today. Please call in 843-300-7870. That's my cell phone. You can call into the studio at 843-556-1250. Please call in, ask any questions. We can talk about your situation, any general questions you might have. Again, that's 843-556-1250. You can find me at my website at www.lowcountrylending.com. And if you give me a call, if I can't help you, I know someone who can. If it's a financial advisor, or if it's help with auto insurance, or if you need to find a realtor, I promise you I've got local partners who can help you through the process or whatever question you might have. I've got people that are at the top of their field here local in the local Tri-County area, people that I have worked with time and time again. I have been through this process, been through real estate transactions. I do 200 to 250 of these a year. So I know who's going to be strong and who's going to do a great job for you. I've already done the vetting for you. Please call me and I'll be able to put you in touch with someone, someone who's at the top of their game, a realtor who serves your area, who can serve your needs and specializes in what you're looking for. Partners like Jimmy Foti at FotiLawFirm.com. You can find him at FotiLawFirm.com. Jimmy Foti's a prominent real estate attorney here in the Tri-County area. Andrew Muller, president and owner of Mappus Insurance. Mappus Insurance, located downtown, local, right here. A very strong and powerful insurance, homeowners insurance, property and casualty company. You can find him at www.mappusinsurance.com. Please give me a call, 843-300-7870. That's my cell phone. I'd be happy to put you in touch with these people. We spent the first segment talking about common mortgage mistakes. We got through 3 of them. The first one being putting more money down on your house. Put more money down on your house does not mean you're going to get a better interest rate necessarily. Lender paid mortgage insurance. I think this is a sales gimmick. Lenders are selling this, telling you you're going to save money, but it's going to cost you money in the long run. The bank wins. That's my catchphrase. When you talk about lender paid mortgage insurance, the bank wins. The consumer doesn't win. Don't do it. I can talk to you more about it. Why, if you didn't hear the first segment. Cashing out to avoid mortgage insurance. Don't dump all your savings into your house trying to avoid mortgage insurance. Mortgage insurance is not the end of the world. When you're doing a conventional loan, it's going to go away in 2 years. It could go away as quickly as 2 years. I think 10% down, I think that's a perfect number, because you're going to have a very, very small, relatively small mortgage insurance payment. You've already got 10% equity. You only need to get to 20 before it's going to go away. So cashing out and exposing yourself to needing a high interest credit card or needing to go out and get a car loan or not having reserves in the bank if something unforeseen happens. Don't do it. Don't pull out all the stops to avoid mortgage insurance. I'm not saying to not put 20% down. If you got the cash, that's a pretty number. It's a magic number, and it's easy to get qualified with a house when you're putting that much money down. So, but I'm just saying, don't cash out to do it. The fourth one I want to talk about is paying points, discount points to buy down your interest rate. I think that this is a huge mistake. I think that this is old mentality thinking. I think that this is the thinking that was back when interest rates were higher and people came up with buying down points. And I think it tends to be a sales gimmick as well. I don't think that buying down points and trying to get a lower interest rate is really ever in the best interest of the consumer. And here's why. A very similar conversation to why you don't want to put more money down on the house is similar to why you don't want to put more money down on points and pay more closing costs to avoid payment. When you put down, let's say you were going to buy down an interest rate and you're going to put 1 point down to buy down the rate, and it's a $200,000 loan. 1 point is the equivalent of $2,000 in additional closing costs. So you're agreeing to basically pay your interest up front. So you take that $2,000 out of your pocket and you pay it at the closing table. And in this case, we'll say that your interest rate goes from being 4% to 3.875%. So you save with that 1 point buy down 1/8 in interest rate. All you've done is shave $25 a month off of that $200,000 mortgage by taking $2,000 out of your pocket. $25 a month. Now, what else? That $25 a month, again, it's tax-free. So it's really an equivalent net cost of $18 a month. $18 a month divided into the $2,000 that you spent to avoid that eighth in interest rate, well, that's 111 months. Almost 10 years of making payments before you make that money back. 10 years. Now, let's go even a step further. What if you were to take that $2,000 and you were to invest it in an IRA, in a 401k, in a Roth, in a mutual fund? Well, if that $2,000 earns any more than the 4% that you're trying to avoid, the 4% interest on that mortgage you're trying to avoid, guess what? You'll never make the money back because it's going to grow at a faster pace than the interest rate you were trying to avoid. You'll make more than $25 a month as long as that $2,000 is earning greater than 4%, which over time, over the course of 30 years, you better be earning more than 4% on your money over the course of 30 years. You're going to make more than $25 a month with that investment than the interest you're trying to avoid. Plus, that interest you're trying to avoid is tax-free. So I just don't think that it's in the best interest of the consumer to buy down, to pay more closing fees. The bank gets theirs. How else can the bank win? Well, if you refinance or sell your house or go anywhere prior to that 10-year period when your break-even point happens for paying that point down, well, you just gave the bank their money and they said thank you and they walked away from it. You never recouped it. If you move inside of that 10 years, you're never going to recoup it. The money's gone. Poof, it's gone. So the bank knows that. The bank structures it. When you buy down points, they structure it so that they get theirs. I promise you, they're getting theirs. So my advice is actually to do the opposite. A lender credit. Take a slightly higher interest rate and have the lender give you money. That's your choice too. Instead of taking that 4% rate, say, no, bank, I want 4.25% and I want you to give me $3,000. Because I don't want to pay my closing fees. I want you to pay my closing fees, and I'm okay with taking a slightly higher payment and keeping that money in my pocket and putting it towards a higher interest credit card or a higher debt or towards student loans or towards my car payment or into a mutual fund where I know I'm going to earn more than 4% that you're trying to tell me I should avoid. Paying points to buy down the rate, it's a mistake. Don't do it. Do not do it. All right. So I want to transition really quickly in the second half of this segment into some changes that are coming up on August 1st, and it's called TRID. TRID changes have been put in place by the CFPB, the Consumer Financial Protection Bureau, that's here to serve the customer, to serve the consumer, to serve you, to protect you from the scary world of the mortgage bank. And what they're saying is, here's the major change. I don't have a lot of time to get into too much details, but the major change is that from now on, after August 1st, it's going to be a requirement that banks provide you with your closing disclosures, your HUD, the equivalent of a HUD-1. They're going to be required to send you those closing disclosures 3 business days prior to close. Now, you might be out there thinking, if you just did a closing and had a closing thing, thank the Lord, because I just had a real estate transaction and my closing documents didn't show up until I'd been sitting at the attorney's office for 20 minutes. And man, would I have liked to have seen what I was about to sign a couple days early. Well, that is a good thing. I agree. That's a good change. The bad thing is the way that this change is going to be implemented. The CFPB and the TRID laws have required that banks are accountable to the time and can prove that they have met these requirements. One of those requirements is that if we mail that package out to you, that we cannot assume that you've received it for 3 business days. So we have to mail it out, wait 3 business days, then, okay, now you've received it. Now we have to wait another 3 business days for before we can close. If things change on that closing disclosure, that clock could reset. Sometimes it'll reset, sometimes it doesn't require to be reset, but it could reset. So let's say something is wrong and it resets the clock. Now you could be waiting another 7 days. There are banks out there that are taking 50 days right now to close a government loan. If you're doing an FHA loan or you're doing a VA loan, you're going to call up, they're going to say, oh, you want to close in 30 days? I'm so sorry. You got to do it for 50 days. What this is going to do, if they're just going right up to the very last second to get those loans done now in 50 days, and now the government is placing an additional requirement for a 7-day waiting period before closing, that 50-day timeline just turned into 60 days immediately. It just happened. Now, how does that impact the consumer? Now, you're the average-blooded American. You're going to put money down in your house and you're getting a mortgage to buy a home, and you've just been told, you're a veteran and getting a VA loan. You've just been told it's going to take you 60 days to close this VA transaction. 60 days to close. Well, just so happens it's a hot market, and you're up against somebody who's willing to pay cash for this house. And the cash money has said, I don't have to follow these new rules. I'll close in 2 weeks. Think of the competitive disadvantage that you are at because you're getting a mortgage. 60 days compared to 14 days. Well, I'm here to tell you, movement, we're not buying into all the delay. We already moved so fast that we are still committed that we can close your loan in as little as 9 days. We'll close your loan in 2 weeks. We'll close it in 3 weeks. You read a 30-day contract? No problem. We're not going to slow you down. Right now, I have got customers by the droves coming to my team and I because the bank has told them we can't close for 50 days. We can't close for 60 days. I can't wait for the TRID changes to happen because when it does, they're going to start saying 75 days, and I'm going to be able to look at my real estate partners in the eye and say, I'll still do it in 2 weeks for you. I'll still do it in 3 weeks for you. You got a rush situation? I'll do it in 10 days. I'll do it in 10 days. Movement Mortgage will get it done for you. We put the systems in place to get it done. We're not going to let you be floating out there in no man's land wondering if your loan is going to close for 75 days like the big box banks are doing out there. Like I hear all my peers at working for the other companies are terrified of this change because they're scared of how slow this process is going to be. Movement Mortgage is not slowing down. Please call into the show, 843-556-1250. We'll talk about this. We'll talk about what's going on in your life and in your mortgage situation. You can reach me, Bill Sandvig, anytime at 843-300-7870. You can find me on my website at www.lowcountrylending.com. When we come back, we're going to tap into why Dave Ramsey, the king of finance, is wrong. Why he's wrong about your mortgage. Stay right here. Don't go anywhere. This is Mortgage Matters here on WTMA, the Big Talker.
Bill Sandvig has more Mortgage Matters straight ahead on 1250 WTMA, the Big Talker. WTMA. This is Mortgage Matters on 1250 WTMA. From Movement Mortgage, here's Bill Sandvig.
I'm Bill Sandvig. This is Mortgage Matters. If you've been listening to the show so far today, we've gone over common mortgage mistakes. I'm going to go over them one more time really quick. Putting more money down in a house. It doesn't save you interest rate as much as you would think. A common misconception. It's not necessarily in your best interest to put more money down on your house. It won't save you as much payment as you're thinking. Lender paid mortgage insurance. Don't do it. It's just not in your best interest. The bank wins every time if you do lender paid mortgage insurance. The bank gets theirs up front rather than you getting a lower interest rate and saving more over the life of the loan. Mortgage insurance on a conventional loan is temporary, so it doesn't make sense to trade something that's temporary for something that's permanent like a higher interest rate. Cashing out your savings to avoid mortgage insurance. If you have just barely enough saved to put down 20%, it doesn't make sense to scrape it all together and to empty your pockets to avoid mortgage insurance, because mortgage insurance, like we just said, it's temporary. Don't put yourself in a spot where you're going to go get a high interest credit card or put furniture on a high interest credit card or put yourself in a bad spot just trying to avoid that mortgage insurance. Mortgage insurance, it's temporary. It's not as bad as everybody thinks. Paying down points to get a better interest rate. The bank wins here too. When you pay down points, your closing fees go up, your payment doesn't go down as much as you would think, and it's going to take years, up to 10 years, to make that money back that you're trying to avoid. And I think you should go the other way. Take a slightly higher interest rate so that the bank can give you money at closing so they can put more money in your pocket. So there's a common mortgage mistakes. We talked about really quickly about TRID changes. This is rules that are changing all the documents and all the disclosures that you're used to hearing. A lot of people ask me about, can I see the GFE? Well, you're in about a couple months, August 1st, you're never going to see a GFE again because it's going away. The TRID changes are intended to be in the best interest of the consumer. There are some positive things. The positive things being that you're going to be required, government mandated, to see your closing documents at least 3 or 4 days prior to closing. The side effects of this change is that what's already a very slow process for most companies, I mean, the big box banks out there, I'm hearing from my peers and from my former coworkers, They can't close government loans, FHA loans, VA loans in less than 50 days right now. And when these TRID changes come out and go into effect, that 50 days is going to quickly stretch to 60 days, maybe 75 days. I've even heard people say 90 days. Can you imagine writing a real estate contract for 90 days? Here's the major side effect, and I brought it up in the second segment. Imagine if you're going to your bank and they say, I'm sorry, we can't do this loan faster than 75 days, and you fall in love with a house, and there's somebody out there that has the ability to pay cash, and they can close in 2 weeks or less. How can you possibly be competitive in an environment where someone else can close in 2 weeks and you can't close for 75 days? That is not in the best interest of the consumer. So we talked about TRID changes, and I'm here to say that movement, we're not slowing down. We are welcoming TRID with our arms open, going to give TRID and the CFPB a big giant hug because they just increased our competitive advantage. We're not slowing down. We've already got systems in place. We are already structured to be able to close your house in as little as 8 or 9 days. So we don't need to go to 75 days. We couldn't even imagine it. It's actually a pretty amazing number that across the entire company, in all loan situations, in all loan scenarios, the average time that a loan is in our processing center is 24 days. That's the average time, 24 days. There are plenty of times where people don't need to close fast. They go under contract, and they're under contract for 2 or 3 months because they're waiting for a house to be built. So imagine how we can keep that number so low when there are those outliers like new construction homes that are driving that average way up. 24 days is our average. I closed in the month of May, I closed 4 loans in 8 days, 8 calendar days. So we're not scared of TRID. We're welcoming it with open arms because everybody else is going to keep slowing down and we're going to keep going faster. If you want to take advantage of that going faster, you can call me anytime, 843-300-7870. You can find me on my website, www.lowcountrylending.com. Please call into the studio. We are live. Call me, 843-556-1250. Here on 1250 WTMA, The Big Talker. Call in. We'll talk about what you got going on. But now we're going to talk about Dave Ramsey and why Dave Ramsey is wrong about your mortgage. So if you're familiar with Dave Ramsey at all, he's got the 7 baby steps to financial peace. And most of the things in these steps I really wholeheartedly agree with, and I share it with customers a lot. I talk about some of these things frequently. I'm going to go over the steps really quick. The first one is baby step 1, start an emergency fund. Of course. Step 2, pay off all your debt using the debt snowball. This is a very easy concept. Basically, it says if you've got $1,000 worth of total debts that you're responsible to pay for, you focus on one, you pay it off as quickly as you can, and then instead of taking that disappearing liability and putting it in your pocket or spending it on things you don't need, you take that money and you now focus even a larger payment onto the next debt. And when that's gone, now you've got even more money to focus on the third one. And by the time you get to those last debts, you're putting so much money towards those final debts that they're gone in a blink. I love it. It's a great concept. Everybody should be out there doing it. You don't have to change your quality of life and change your budget, and all of a sudden your income, your debts are gone, and the debt snowball. Love it. Step 2. Step 3, put 3 to 6 months of expenses in savings. This is your emergency fund. Not your funny money, not the initial cash that you set aside, but if something severe happens, you have a medical, something comes up, you've got that 6 months set aside that you're going to be okay to recover from whatever might have taken place in your life. Invest 15%. This is step 4. Invest 15% of your household income into Roth IRAs and pre-tax retirements. Excellent. Invest as much as you can, save as much as you can. Step 5, plan for college funding for your children. Even if they don't end up going to college, start saving for it. But here is where I disagree. It's step 6. Baby step 6 is pay off your home early. He says, after you've achieved all these other things, I want you to just start pumping money into your mortgage. Well, I don't think that makes a whole lot of sense. We're going to scroll back to step 4, where he says invest 15% of your household income. Inside of that step, if you read, he says that you can expect about an 8% return average annually on any mutual fund investments and any investments that you make. 8% return on average. And I've done the research. He's correct. There's actually been no 30-year period in history that the Dow Jones hasn't increased by an average of 8% a year. There's never been a time where it's been less. So the most conservative 30-year period, an 8% return on your money, can be expected. Well, why, Dave Ramsey, should we pay off a mortgage that has a 4% interest rate as fast as we can when you've told us that we can get an 8% return if we put it somewhere else? My argument is you shouldn't. I want to run a quick scenario for you guys. There's a little bit of numbers here, a little bit of math. I'm going to try to make it simple so you guys don't get lost. So try to stay with me. If you have $200,000 sitting in your bank account and you want to buy a $200,000 house, you have a choice. You could take that $200,000 and you could pay cash for that house, or you can take that $200,000 and you can invest it into a mutual fund. If you were to invest that $200,000 into a mutual fund rather than pay cash, well, let's take a step back. If you were to get a $200,000 mortgage, the monthly payment on that mortgage, just the principal and interest, would be $954, assuming a 4% interest rate. $954. Well, if you were to take that $200,000 and put it into a mutual fund and get the 8% return average annually that Dave Ramsey tells you should expect, and you take $954 a month, every month, you take it out of that account and you pay your mortgage with it. You now have the exact same situation you were trying to create by putting all the money down in the house. You don't have to budget for that mortgage payment because you're taking $954 out of that savings every month, right? So here's what happens at the end of 30 years. At the end of 30 years, that $200,000 has grown to $322,000. You started with $200,000. 30 years later, you have $322,000. But what else? All your mortgage payments were made by this investment account. So at the end of those 30 years, your mortgage is paid off. Your mortgage is gone. You have $322,000 in the bank still. What happened if you had just taken that $200,000 and paid your mortgage off? Well, in 30 years, you still just have a mortgage paid off. And you're down $322,000. That's why I think, Dave Ramsey, you're wrong here. You shouldn't be pumping your money into such a low interest rate liability. 4%, it's cheap. It's free money. Take that money, have it grow, have it work for you. That's why Dave Ramsey's wrong. We're here with Mortgage Matters on WTMA, the Big Talker. I got one more thing to talk about. Don't go anywhere because we are going to talk about positioning yourself in today's market so that you can get the house you want. It's going to be all about leverage, all about you getting a home you want. So don't go anywhere. Sit right here. I'm Bill Sandvig. This is Mortgage Matters.
Mortgage Matters continues next on Charleston's Big Talker, WTMA. Now, let's get back to Mortgage Matters on the Big Talker. From Movement Mortgage, here's Bill Sandvig.
This is Mortgage Matters, and if you're out there listening, please call into the studio here at 1250 WTMA, the Big Talker. 843-556-1250. I'm here to answer your questions. You're out there, you're listening, you're a Dave Ramsey fan, and you want to tell me why I should never say anything against what Dave Ramsey has to say. I want to hear from you so we can talk about it. Or if you got something about a mortgage situation or a real estate transaction that's just gone sideways, you need some advice, something you want to share with the world, please call in. If you want to just talk to me, you can reach me on my cell phone, 843-300-7870. You can find me on my website at www.lowcountrylending.com, and you can fill out a buying power evaluation where I am going to be able to break down what options you have, how much can you spend, what programs are available for you to get into a new house. Maybe the time is now where you're ready to upsize or you're ready to break into the investment world, break into a second home near the beach. Hey, we're in Charleston. It's a beach community. It's time to start making those decisions. Reach out. My free buying power evaluation will be here. It's there for you. It's service to you. It doesn't cost you anything. The last thing I want to talk about is the real estate market and how you can position yourself to making an aggressive and strong offer in what is a very, very hot real estate market. Inventory is down, the buyers are up, and that means it is a seller's market right now. Every single day, I would say more than 50% of the contracts that are going out there right now are ending up in multiple offer situations. What does that mean for you? That means when you go out looking for a house on a Saturday, you're not the only one that's interested in that house. You're not the only one that thinks that's a good deal. The other people are out there. They've got their eyes on the prize as well. And you have got to do whatever you can to get leverage and to get yourself in a position to win that house that you and your family fall in love with. If you don't, you're going to find yourself out the next weekend looking at the next house, and you're going to find yourself out the next weekend looking at the next house. And then all of a sudden you're going to start going outside of your comfort zone. You're going to start saying, well, we'll offer more than asking price. We'll offer whatever they want, whatever the seller wants. Just give it to them. I just want to give them my house. Let's not get there. Here's how. You call Movement Mortgage. And what we're going to do before you even go out and look at that house on Saturday, we are going to take all of your loan documentation, every single piece that's required for you to be fully approved. We're going to collect it and we're going to send it into the underwriter. We're going to send it into our processing center. You don't have to have a contract. You don't have to have a house. I know of no other company that's doing this. They'll say they do it, but it's going to take them weeks. It's going to take them 3, 4, 5 weeks before they'll prioritize you over the people that have contracts, over the people that are doing refinances. They are going to backburner you. Here at Movement, we don't do it. You call me on a Tuesday, I collect your documents. I'm going to submit your loan that Wednesday. In 6 hours, 6 business hours, our underwriters are expected to review your file, and they're going to issue a commitment letter, a commitment to you, a commitment to lend on the house that you don't even have yet. Now, think about where you are. Think about the position that you're in. You look more like cash. You have a letter that says you're approved. You're not pre-qualified. You're approved through underwriting. And what's furthermore, because we've done all the hard work up front, because you have that commitment letter, now you're in a place where when you make that offer and you're being compared to other people that have just pre-qualification letters, they're going to be out there writing 50-day contracts, writing 60-day contracts. And now what we've done, what I've done, what Movement Mortgage has done, what your realtor partner has done by referring you to Movement Mortgage, is they have put you in a place where you could close in 2 weeks. You could close as quickly as 2 weeks. What does that sound like? A 2-week real estate transaction? It sounds like cash. We just took the work. We dedicated the man hours. Movement Mortgage made the commitment to dedicate the time, money, and energy to put you in the best place to get your house at the price you want and the house that you want that's at the top of your list, because we care. We care about our real estate partners. We care about you. We care about the consumer. We don't want you to go through week after week after losing out on multiple offer situations, the stress of wondering if you're going to be moving, wondering if, oh my gosh, our house just sold. We put it on the market. Now it's sold. We've got to find a house right now. We've got to find one, because if we don't, we've got a closing date coming up and we're going to be moving in with mom and dad. We don't want that. Movement Mortgage doesn't want that. We want to work together with you and plan ahead. We want to give you the leverage and the buying power and the opportunity to get into the house that you love, the house that's sitting there at the top of your list. That's what I want for you. I want this to be a stress-free transaction. I want to give you the power to make an aggressive offer and to win out on the first time. When we do this work, when we do it up front, when we work out all the kinks, we open all the closets, and we go through this mortgage process up front with upfront underwriting, everybody wins. I have seen countless situations where my buyers are getting the house they want at a cheaper price. They're winning even though their offer was less than the competitor. Why? Because we wrote a little 2-week closing date on it. The competitor wrote a nice little 60-day closing date on it. And what happens if the seller goes with the 60-day? They got to make 2, maybe even 3 more mortgage payments. With us, they make no more. They made their last mortgage payment because they're not going to have that house anymore in 2 weeks. That is a win for them. It could be a $3, $4, $5, $6, $7, $10,000 difference to that family by not making those 3 additional mortgage payments. That is giving you leverage. That is what Movement Mortgage has committed to do for you, to get you into your house, to make this a painless process. It doesn't have to be painful. We can plan ahead, work together, make a difference, get all the hard work done, and get you into your house and get you into your house fast. We do it with 6-hour underwrites, 7-day processing, and a 1-day close. That's why we're the fastest mortgage company in the industry. That's why we are the fastest growing mortgage company in the country. That's why when you call Movement Mortgage, you are going to get a professional who's going to set you up for success. I'm Bill Sandvig. You can find me anytime, 843-300-7870. You have been listening to Mortgage Matters on 1250 WTMA. We'll be right back, and that's why Mortgage Matters.
You've been listening to Mortgage Matters with Bill Sandvig from Movement Mortgage. Call Bill for your mortgage needs at 843-300-7870. That's 843-300-7870. Listen again next week at this time for another edition of Mortgage Matters with Bill Sandvig on 1250 WTMA.